Hi, folks. As you know, our topic for today is reviewing your portfolio. And we couldn't be more excited to discuss it with you. In fact, we have been waiting a long time to bring it to your attention because, frankly, we feel that as a financial advisory firm, if you can't somehow separate yourself from the pack in terms of how and why you do things and the value that you can bring to a client, then there really isn't any reason that people should listen or want to work with you. So when I personally hear most of the advertisements on TV, the radio, or online for most of the big financial advisory firms, they all sound the same to me. So when I see them, the first thing I think is that I guess the only reason they get so much business is because they're a household name, not because they somehow said something that convinced people that they were different or that they could bring them a value that other firms can't. That's why our two goals for this webinar today are, first, to educate you guys on the fundamentals as it relates to reviewing your financial portfolios, and secondly, to discuss some of the most important investing philosophies that we as a firm think separate us from the pack when it comes to this topic and what we do with our clients. But before we do that, I want to thank each of you for joining us today to discuss this extremely important topic. My name is Brian Dougherty of PLC Financial Solutions. I'm your host, along with my beautiful, wonderful partner in business and life, Rachel Dougherty. She'll be our moderator for it, and she'll be handling all your comments and questions as we go along. But before we get started, let's take care of some general housekeeping first. First, if the screen is not big enough for you to read, you can click on the View Options drop down at the top right of your screen. You can just move your cursor around and you'll see it says View Options at the top of the screen. In there, you can adjust your screen to make it larger if you need to. Also, you'll see that there are two boxes at the bottom of your screen. One's called Chat, and it's for your comments, and the other is called Q&A for your questions. Please use them accordingly, and Rachel will respond to them in kind. Next, I'm sure that many of you have had questions about the material that we will be covering today, but since we have a good bit to cover and only an hour to cover it, I'm going to ask you to put your comments and your questions in these boxes below. And at the end, we'll be staying for some extra time to cover as many questions as possible. However, if we don't cover yours, we'd be happy to answer them in either an email or even a 15-minute Q&A phone call scheduled for another time. Rachel will actually be putting up a link for anybody who would like to do that when we get to the end. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You're going to have plenty of time to check it out again at your convenience. Also, because we want to make sure that you're all paying attention and because we'd like to make sure you're having some fun as well, before we answer any questions, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box is going to win a $10 gift card to the store of their choice. So every question that gets answered correctly, we're going to give a $10 gift card to whoever gets it correct. So make sure you have a notebook handy to jot down some brief notes as it relates to some special bullet points that I'm going to point out to you as we go along. Finally, it's my obligation as a financial advisor and a fiduciary to inform you that RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we are properly registered or are excluded or exempted from registration requirements. Also, SEC registration is not an endorsement of our firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have the potential for profit or loss. So now that we got that over with, I have one for you, as always. A hamburger walks into a bar and orders a beer. The bartender says, "Sorry, we don't serve food here." So, all right, I did not get that from my son. I actually found that myself on the internet the other day. So, Rach, I'm actually finding my own material now. Okay. So, oops. Let's just do something. All right, it's working. Okay, so let's start with the basics. So how do you define what a personal portfolio is? This is actually pretty easy. It's quite simple. It's quite simply the collection of whatever your financial assets are at any given time, such as stocks, bonds, cash equivalents, or even alternative investments like Bitcoin or real estate or gold. Anything of value that you own is actually part of your portfolio. You name it. If you invested in it, it's part of your portfolio. So, however, today we're going to discuss mainly the traditional investments in a financial portfolio like stocks, bonds, mutual funds, ETFs, which stand for exchange traded funds, and cash equivalents. So when it comes to these types of investments, you generally want a mix of these types of investments within your financial portfolio to balance growth and risk. How do you do this? It's by creating a balance of the certain types of investments in different proportions. These are different types of investments. These different types of investments are referred to as asset classes, and they generally come in four main classifications. Now, remember I said to take notes? I'm pointing it out. Okay, first classification is equities. Second is fixed income, which is most commonly attained through both owning government and corporate bonds of all different types. Cash and cash equivalents. We're going to discuss that a little more. Real estate and commodities. They're the four basic main classifications or asset classifications. So when you balance these different asset classifications in different proportions, it's called asset allocation. This is what creates a risk-reward profile for your portfolio, which is determined by the risk tolerance that either you or your situation bears. As we go along today, we're going to break down these building blocks related to these things in order for you to wrap your head around these concepts even more. So, why do I even need a financial portfolio anyway? This is actually a really good question, which I get from time to time from people. And the simple answer is that a well-invested financial portfolio can help grow capital for future use in a somewhat predictable way. Of course, there are no guarantees when it comes to investing. However, the long history of financial markets can be very helpful at providing insight as to how markets have performed over the long run, and thus can give you the perspective you need to feel more comfortable about investing long-term into a financial portfolio. So even though there's always risk involved when it comes to investing, since the goal is to fund the future of yourself and possibly even your children to a certain degree for generations to come, creating a financial portfolio for the long run is possibly the safest and most predictable way to achieve these things. Plus, since we all like to or may have to retire someday, having a financial portfolio and plan to do so has historically proven to be the most prudent approach to reaching that outcome. So both creating and understanding your financial portfolio is paramount when it comes to meeting your financial goals. Okay, now that you guys kind of got a basic idea of the makeup of most financial portfolios, let's talk a little bit about diversification. Having a diversified portfolio allows you to spread capital across more than just one investment category. Diversification into multiple asset classes will help you to protect capital in the event that one or more asset categories does not perform well at any given time. Essentially, diversification is a technique used to reduce risk. Remember, I told you to take those notes and bullet points. I'm going to repeat that. Essentially, diversification is a technique used to reduce risk. The goal is to maximize return by investing in different areas that would each react differently to the same market-based event. Diversification is considered by many to be the most important component of reaching long-term financial goals while minimizing risk. There are two main types of risk when investing: non-diversifiable and diversifiable. Let's dig into them a little more. So, non-diversifiable risk. It is associated with every company that exists. This type of risk is also known as systematic risk or market risk. Okay, so these factors include things like inflation rates, recessions, exchange rates, political instability. We all know about that these days. Natural disasters, terrorist attacks, war, and interest rates. This type of risk cannot be eliminated through diversification, though it can be hedged against in some types of ways. So in essence, non-diversifiable risk is basically risk that diversification in your portfolio isn't going to help you avoid. So now, then there's diversifiable risk, and that's also known as unsystematic risk. Now, that can be reduced through diversification. You can invest in different companies, industries, markets, economies, and even different countries to mitigate your risk. This is what's known as having unsystematic risk, because none of these are dependent on the same system for their success. Thus, this form of risk can be reduced simply through portfolio diversification. Here are a few types of unsystematic risk that exist. Things like if a company were to incur new competitors all of a sudden, or new regulations come out, or a shift in management, or a product recall. So that happens to one company. It's not going to matter if you've diversified in your portfolio so much, because it doesn't mean that it happened to the rest of them. Now, these things would be specific to a single company or industry and could cause one investment or one group of investments. Sometimes it could be more than one investment, but one group of investments that fits in a certain group to incur losses, but not an entire diversified portfolio, like what would happen if there was another like what happened when there was the worldwide crisis, like the current pandemic caused in March of last year. That was undiversifiable. It was worldwide. So in these types of diversifiable risks, as long as it's only going to affect one or a certain category of investments, it doesn't mean it'll happen to the rest. And so it's not, so that's why it's called a non-diversifiable, that it's a non-diversifiable event when it is something that causes all asset classes to lose value at the same time. On that note, let's discuss market risk a little bit more. There are four main types of market risk. Now, remember I said to take notes. This is a bullet point. There's one, interest rate risk. And that is the risk that an investment's value will change due to a change in the absolute level of interest rates. This type of risk affects the value of bonds more. It affects the value of bonds more directly than it does stocks. As interest rates rise, bond prices fall, and vice versa. So the first one was interest rate risk. The second is called monetary policy risk. So remember, we're going over the four types of market risks here. The first was interest rate risk. The second is called monetary policy risk. And that impacts interest rates through regulatory committee decisions that determine the size and the rate of growth of the monetary supply. In the US, we have what's called the Fed. And the Fed makes these decisions on how our interest rates are going to go up and down. And as a result of that, how much money is going to flow into our economy or not. So that's the second one, monetary policy risk. The third is commodity price risk. Now that impacts raw material inputs such as cotton, corn, wheat, oil, sugar, soybeans, copper, aluminum, and steel, and there's a lot more. This type of risk not only impacts the raw material, but commodity users as well. For example, as the price of steel rises, this increases the cost of automobile production and can negatively impact the producer's profit margins. Also, political and regulatory changes, seasonal variations, weather, technology, and market conditions can all impact commodity prices. So commodity price risk is definitely a market risk. Finally, the fourth market risk is called currency or exchange rate risk. So our monies actually exchange at different values when compared to different countries. So this is the price of one currency in relation to another. Assets or business operations across national borders are exposed to currency risk. This type of risk can be reduced by hedging, which offsets currency fluctuation. So having ownership of different currencies can help hedge that. So now that we've discussed why it's important to diversify, let's take a look at how to diversify through different asset classes. So asset classes are groups of similar types of investments. To have a diversified portfolio, you need to have a variety of asset class investments. For example, if you invest in an equity stock, in equity stocks, even among different companies, you're still at a higher risk of loss because equity stocks will typically act the same when there's some type of a market episode of some sort or correction. If one equity stock drops, you can expect others to drop in price as well many times. This is going to leave you short on investment funds if you have too much invested in just equities. So the different class types. Again, bullet point, keep the notes, equity stocks. So by purchasing a stock, you actually own a piece of a company. Second, Fixed income or debt. When you buy a bond, you're actually lending money to a company or government for interest in return. You're purchasing either government bonds or other types of bonds, or a certificate of deposit, for example. All of these are really debt instruments where you're lending money to some type of institution in order to get interest in return. So, third, cash and cash equivalents. Okay, the money in your savings account, in your pocket, or hidden under your pillow, this is actually a promissory note from a government that they are holding for you a certain amount of value, which used to be gold. I'm not exactly sure what it is now, probably military strength. But that's what your actually cash is. It's actually a promissory note. So, and next, real estate and commodities. So owning something physical like property, natural resources, are actual commodities. And precious metals like gold is a commodity. So these are actual physical things that you own and are considered their own asset class. At different times in our history, these different asset classes contributed in different ways to an investor's portfolio. Currently, they do not all hold the same value in a portfolio that they once did. But the reason that many investors invest in them anyway is because they're all part of their own separate and independently functioning markets. So when one market is up, another can be down, flat, or up as well, because these markets do not necessarily, they do not actually correlate with each other. Not directly, anyway. So now, let's look at each of these asset classes individually. Equity assets are commonly referred to as stocks or shares. Like I just mentioned, they represent a share of ownership in a publicly traded company. Because equity assets are publicly traded and owned, its share price is publicly daily. It's published daily, providing transparency. The risks or potential drawbacks as it relates to equities are: one, prices are subject to large movement in the stock market because investors can experience large gains or losses at any given time, which is referred to as volatility. The higher the volatility of a stock or any asset, the higher its risk. This is why equities are considered the riskiest type of asset class. Now, what are the benefits of equities, of owning equities? They have produced higher returns than most other asset classes over a long period of time. Typically 7 years or longer is what is a reasonable time horizon for these. Second, many companies may pay dividends to shareholders, which can provide a steady source of income on top of the value of the stock. Third, the longer you stay invested in equities, there is a certain amount of gain above the principal investment that will occur, and then the chance of loss of principal is reduced over time. Now, let's talk about fixed income. Purchasing a bond is a type of loan, like I said. You're essentially lending money to an entity so it can raise funds and finance spending for it. When a government spends more on health, education, infrastructure, etc., than it receives in taxes, it needs to borrow the difference by issuing bonds. These are referred to as government bonds, sovereign bonds, or gilts. So, what are the risks versus benefits here? The prices of bonds, so the risks are the prices of bonds fall as interest rates on new bonds being sold rise. which causes anyone holding older, lower interest-bearing bonds to lose value on the asset if they desire to sell it before it matures. Secondly, they also come with repayment or credit risk, which is the risk that a bondholder, usually a corporation, but could be a government, depending on what government issues the bond, not being able to repay when the bond matures. The company or the government could go bankrupt. So that's a credit risk that you take on. What are the benefits to the bond? Well, first, they're generally regarded as safer investment options, as prices historically have moved less sharply than equities, so they don't fluctuate and have high volatility at nowhere near the same rate as equities do. They typically provide a high level of income. Well, maybe I don't know if you can consider it a high level, but I guess compared to some bank rates or what have you, Plus, they have a medium or long-term capital appreciation with relatively low risk. So, third, they can be inflation linked. So sometimes you can link them to inflation in order to provide investors with some degree of protection against rising inflation. The U.S. government sells what's called TIPS bonds, which stands for Treasury Inflation Protected Securities. They work by increasing the principal of the investment by whatever the CPI or consumer price index inflation rate is for any given year. Let's talk a little bit about cash equivalents. Cash investments are a range of securities that typically take the form of short-term loans that pay regular interest. Repayment is happens in usually less than 1 year. Generally, cash equivalents are associated with money market investments because money market investments have a short maturity period. Interest paid is generally lower than bonds, but asset managers hold a variety of money market securities for their diversification benefits. They're made up of various companies, banks, and government borrowers with various maturities up to 12 months. So the benefits of cash investments are, one, they're shorter term investments where the money is essentially easily accessible and generally very liquid. Two, they offer better returns than the interest paid by a bank account. At times, keeping up with inflation, but not always, and especially not right now. Third, money market unit trusts are also more flexible than term deposits offered by banks, with no fixed waiting period before withdrawing your money. And finally, they're among the lowest risk investments held by unit trust funds other than the physical cash or bank note. Now, what are the risks for cash alternatives or cash equivalents? Since they yield such low returns, they can cause an investor to incur what's known as an opportunity risk if they're too heavily invested in. So, just the opportunity to invest in something else that could have a higher yield. They could fall behind on it with, and secondly, they can fall behind inflation, which they have recently, and thus cause an investor's portfolio to not keep up with inflation and thus lose value as it relates to the future value of money. Okay, the final asset class. When it comes to the real estate asset class, there can be a few different types of real estate investment approaches that are considered. One, you can own property directly, either residentially or commercially. In this way, someone can either collect rent and capitalize on capital appreciation, or just flip properties for the capital appreciation and profit, thus profit. Secondly, you can invest in property development by thus build new properties for profit as a contractor or appreciation as an owner. Third, you can invest in real estate investment companies, which make profit from investing in companies that do one or both of those above, those first two options. When it comes to real estate investment companies, a listed property refers to property companies listed on a stock market. So if it's listed on a stock market, it's known as a listed property. This asset class gives investors exposure to various types of property, including industrial, office, commercial, and residential space. A share in a listed property company is an equity investment subject to the rise or fall in its share price over time. So it really becomes an equity. The recommended investment horizon for this type of investment is 5 years or longer. What are the risks? This asset class is associated with medium or high risk because it's medium to long-term capital and income growth potential. Secondly, many of these investments are illiquid due to property itself being illiquid and illiquid asset. Third, the real estate market can be highly volatile due to it being so closely related to the banking and mortgage-based markets, which are highly sensitive to interest rates and mortgage-based investments, i.e., for example, the 2008 Great Recession, which was caused by the subprime mortgages that were bundled into mortgage-backed securities. Certainly some risk there, and we have experienced it. Now, what are the benefits to investing in real estate in these various ways? Well, real estate assets provide income in the form of regular shareholder distribution. The distributions are usually more reliable over time based on rental incomes that rise over time. Also, listed property is considered a separate asset class to other equities because it offers characteristics of both equities and bonds. And finally, listed property stocks are less risky than other equities since their distributions are likely to be steadier. All right. Now that we have a better understanding of what your portfolio is made up of and why it's made up of it, let's discuss the different asset allocation choices that most investors have today and why. Most financial portfolios have asset allocation choices based on each investor's personal risk tolerance. Now, in order to accommodate large numbers of investors, every asset manager provides several investment portfolios that have different blended proportions of the asset classes that, when together, create a specific risk level for the portfolio, and they offer this in advance. They generally break down like this. It can be made up of 100% fixed income. By the way, and I mentioned this earlier, but fixed income is normally some type of bond or bond-like investment instrument or debt-related instrument. So it can be made up of 100% fixed income. And this can be considered highly conservative. Or can be made up of 80% fixed income and 20% equities, which is considered conservative. Not highly conservative, just conservative. Could also be made up of 60% fixed income, 40% equities, which is considered moderate. Could be made up of 50% fixed income, 50% equities. And you can see how you go through. That's considered moderate. And by the way, I want to point out, as you're taking your notes, this is a bullet point right here. So a 50% fixed income, 50% equities make up a portfolio, made up portfolio is considered moderate. 40% fixed income, 60% equities is considered moderately aggressive. And 20% fixed income, 80% equities is considered aggressive. And 100% equities is highly aggressive. So, by the way, you could go up in intervals of 10 as well. You could have a 90% fixed income or 10% equities, which would still be in the conservative area. So there are always some slight variations from these predetermined asset allocations, but these are the most standard combinations that you'll see out there today. Also, the individual investments within these asset classes vary tremendously from one portfolio to the next and from one asset manager to the next as well. So what that actual 80% in equities actually is made up of in terms of investments can be really unlimited. It just has to fall into an equity category, asset class. However, whichever investments that they use, they'll usually fit into either fixed income, which is also a slash bond, or an equity slash stock asset class. These days, it usually does. Also, you don't see that here, but this is just a rule of thumb. Every portfolio, regardless of what the asset allocation is, and that's what we just discussed, those portions of fixed income to equity or equity to fixed income are called asset allocations. They're there's usually always going to be somewhere around 2% in cash or cash equivalents in each of those portfolios to keep some liquidity available in the portfolio for quick access to clients and the portfolio's periodic expenses. So now that you have a basic understanding of how most portfolios are constructed as it relates to risk, let's take a look at the different types of investment management strategies. Again, here's a bullet point. Let's take a look at the different types of investment management strategies that are employed in order to pursue investment returns. So the types of investment management strategies in broad terms that are out there today, the first is called passive investing. You could consider that set it and forget it type investing. This is basically how most Vanguard portfolios work. Or there's also active investing, where asset managers make active choices on what to invest in and when, and this causes investments in the portfolio to change periodically. It usually does not change asset allocation in the portfolio. So trades are usually made within the current asset allocation makeup. So in other words, if the financial advisor who created or the client who created that portfolio wanted a 60% equity, 40% fixed income asset allocation, that active manager would only purchase equities inside that 60% makeup and only purchase bonds within that 40% makeup. And every year, as the equities would grow, Normally, they would do what they call balance it. They'd sell off some of the equities. Let's say they grew, and now the equities aren't no longer making up 60% of the portfolio. They're making up 70. They're going to sell off 10%, and they're going to buy fixed income investments in order to rebalance it to a 60-40 makeup again. So now the next is called tactical, or the third one is called tactical or quantitative asset management. This is active management executed by using algorithms that are fed market and/or economic data that trigger trades at predetermined thresholds. So these portfolios do not have static asset allocation to provide risk mitigation. Instead, they provide ranges of asset allocations. So a moderate portfolio, instead of being set at 50% equities and 50% fixed income, it'll have a range between 65% equities and say 30% fixed income for the moderate portfolio. And I'm going to get a lot more into this as we go along. This is the type of investing that our firm has been leaning toward over the last couple of years. And we're going to take a look at that in a minute. So again, bullet point, the three types that we're discussing here tonight of investment management strategies are passive investing, active investing, and tactical or quantitative asset management investing. So let's try to tie all these things that we discussed into what considerations you should look at most when it comes to reviewing your portfolio, because that's what we're discussing here, right? The factors to consider when you're reviewing your portfolio and what adjustments you may want to consider moving forward. So here's a breakdown of the things that our firm thinks should be given priority based on today's financial markets and investment strategies that are available today. And there's 7 of them. Now, bullet point, okay, bullet point. Remember to keep your notes. So these are the 7 considerations to have when you're reviewing your portfolio. The first is current fixed income market yields and long-term outlook. So you want to know what bonds are yielding today and how long have they been yielding that? What's the market look like? Are they looking like the trend is going up? Is it looking like the trend is going down? Same thing when it comes to equity market returns and the long-term outlook. You want to have an idea historically of what they've received and where is that trending going forward. Third, your portfolio return needs and goals need to be considered. So when you create a plan, a long-term plan, it has to be based on some type of minimal need of return. So you want to take that in consideration. You may have a need for a certain return. You may have a goal for a certain return, which could be a little loftier. Fourth, the potential return of your portfolio's asset allocation makeup. Now, that seems a little complicated, but I'm going to get into that in a little bit so you understand. So, fifth, the risk-reward profile of your portfolio. That's important. I'm going to get into that more too in a minute. Sixth, how volatile is your portfolio? And 7, what is your portfolio's average return versus its compounded annual return? So let's talk about that. So let's talk about the first two, the market-based factors for you to consider. Starting with the current fixed income market yields and long-term outlook. Well, over the last 5 years, the average annual yield of 10-year treasury notes, which is the 10-year treasury note tends to be the mean that markets consider, was over the last 5 years, it was 1.94%, the average. And over the last 10 years, it was 2.3%. Now, if you go back further with bonds, historically, they were actually at 5%. And I think you'll find, if you looked at that data, that they're trending downward. Although the last 10 years look better than the last 5 years, but that's because the last 5 years, they've been trending even more downward. Those first 5, they were a little higher. After looking at this, it's pretty obvious their bond yields have been where they've been trending, and that's been lower. Now, next, let's look at the equity markets and where it's been trending. Over the last 20 years, the average annual return was of the S&P 500 was 7.45%. And when you adjust that for inflation, it was 5.3%. As compared to the last 30-year average, which was 10.72% prior to inflation and 8.29% after inflation was concerned. So obviously, again, returns trending downward. So let's just look at this for a second. If a portfolio, say a $100,000 portfolio, is made up at 30% equities and 70% bonds, you would multiply that 30,000 by 7.45%. This is before inflation. And that would leave $61,500 that was gained over a 10-year period. And that's what this is based on, a 10-year period. You take the 70% or 70,000 that was in fixed income or bonds, multiply that by the 2.3%. That was the average over those 10 years. And now you come to a total of $87,900. Combine the two, and now that $100,000 is just shy of $150,000. It's $149,400. Basically demonstrating a 4.9% return before inflation average over those 10 years. Now, let's look at factors to consider when it comes to your portfolio. To start, your portfolio return needs and goals need to be given serious consideration when you or your financial advisor were creating the long-term financial plan. There had to be a predetermination of what the minimal portfolio return will need to be in order for you to reach your goals. So if it was determined that 5 or 6% was going to be needed in order to meet your needs, your long term, then a portfolio would need to be constructed that has the potential to do that return. Of course, there are no guarantees, but the potential return must be aligned with your needs. This way, you're at least in the ballpark with your planning. This can be calculated in any number of ways. The easiest way would be to use an online financial calculator to assist you. Secondly, you'll need to find out what the potential return is for the asset allocation breakdown that your portfolio is made up of. So for example, you know that you need to make 5% return, but then you test your asset allocation. And when you factor inflation in and all other elements, you show that that particular asset allocation does not show the potential of attaining that return. You probably need to make some changes. So the main issue with fixed or static asset allocations today, is that both equities and fixed income investments aren't returning as much as they used to. I just showed you the trends, both trending downward. And this is causing many investors to have to invest more aggressively than their situation can tolerate if there was a major correction in the markets. So that means the potential return of a 60% equity, 40% bond portfolio, or less than that, 50% equity, 50% bond, is likely not going to return enough. But if you increase the equity portion, it's likely going to cause the portfolio to exceed your situation's risk tolerance level. Meaning that if there's a major correction in the market, your money's going to go down more than you possibly can afford for it to do. So this is why aligning what your portfolio's asset allocation in terms of makeup of equities and fixed income with what your need for potential return is long-term is extremely important. Okay, let's discuss the portfolio factors numbers 3 and 4. That should be considered when reviewing your portfolio for possible improvements. So in factor 3, an analysis of your portfolio's risk reward profile is something that you definitely will want to do. As you can see in this slide, portfolio 1 has a potential 95% historical range of potential return that is in any 6-month period of negative 7.84% up to positive 12.65%. So that's your risk reward profile. You're risking 7.8% of a loss in order to have a potential gain of 12.65%. So that means that in any 6-month period, this portfolio, and this, by the way, is a client of mine's before and after. This portfolio A is the portfolio she had when we first met, and portfolio 2 is the portfolio that the risk reward profile that of the portfolio that we settled on for her, for us to work together. So that means that in any 6-month period, it has the potential gain of a $1.60 or $1.6 for every $1 that it risks. So that's your risk reward profile. I'm risking $1 in order to get $1.6 in return. Conversely, portfolio 2 has a potential gain of $2.35 for every $1 risk. Plus, they both have the potential to average somewhere between 4 and 5% annually as well. This means that portfolio B has a better risk reward profile than portfolio 1. This is an important consideration for any portfolio that is being reviewed. In my opinion, a good risk reward profile is for a portfolio to potentially gain anywhere between $1.75 and $2.5 for every $1 that it risks. Now, let's look at factor number 4, or consideration number 4, which is determining how volatile your portfolio actually is. These same portfolios that we just looked at when it comes to risk-reward profile are also very good examples of portfolios that have similar potential average annual returns, but demonstrate much different volatility potential. Again, since portfolio 1 has a wider range of volatility than portfolio 2, it is, of course, the more volatile portfolio and is thus the less desirable of the two when it comes to this consideration as well. So now let us look at our final portfolio factor to consider when reviewing your portfolio for potential improvements. So folks, the fifth and final factor for you to consider when reviewing your portfolio is to determine how its average return compares to its compound returns. Now, your first thought, like mine was, when it comes to this consideration might be, I didn't know that my portfolio's average return could be actually different than its compounded return. But in fact, it actually can be. And you can only really differentiate this by comparing the actual total dollars earned between the two different portfolios that have the same average return. I'm going to show you what this means in a minute. Also, the variable that causes this anomaly to occur is the difference in volatility between two different portfolios. I'm also going to show you that as well. You can see this clearly when you compare the two wavy lines that are representing two different portfolios on the top graph. The orange wavy line, which represents the more volatile portfolio, has a range of plus 24% in gain and negative 15% in loss in any given year. And the gray wavy line has a range of plus 15% and minus 5%, plus 15% in potential gain and minus 5% in potential loss. And even though they both have an average simple return of 5% annually, the less volatile portfolio produces a 42.5%, which is actually a 5.3% compounded annual return over that 8-year period that you're looking at, versus a 27.4%, or actually a 3.4% actual compounded return in actual dollars. Folks, that is a difference of almost 2% annually. So this is a very big deal over the long run. Also, the spreadsheet below shows you the numerical breakdown of how the two portfolios arrive at these different compounded returns. I created this spreadsheet just so I could actually see how this worked in dollars. And I must tell you that I was completely flabbergasted when I realized this several years ago. So at the end of the day, when you're reviewing your portfolio, making sure that it has a good risk-reward profile that minimizes your portfolio's volatility is of the utmost importance when it comes to maximizing your portfolio's potential. Overall, you're maximizing your portfolio's potential over the long run. So Now you have a good idea of why it's so important for your portfolio to have a good risk reward profile that keeps its volatility under control. You now know one of the main reasons why our firm has preferred and has gravitated toward the tactical approach towards investing over the traditional static asset allocation approach that once was so reliable for many investors. The bottom line is that one of the main priorities when it comes to tactically managed portfolios is to minimize volatility, which in doing so also mitigates the risk of the portfolio drastically as well. It does this by using algorithms that are fed many important numbers that are related to both economic and market historic indicators of health or lack thereof when it comes to them. So the types of investment methodology, this type of investment methodology has been being used at the institutional level for many years now, but it really just become more accessible to the average investor through different third-party money managers over the past 10 years or so. So to wrap things up, let's take a closer look at how a tactical investment strategy works and what it is capable of when implemented into a portfolio. So the concept for tactical investing is to build portfolios that have ranges of equity exposure at any given time. As you can see in this slide, each risk tolerance-based portfolio, they're showing you 80-20, 65-35, 50-50. Each of them has a range of equity exposure that is considered acceptable under normal market conditions and under recessionary market conditions. This means that each portfolio has a sliding scale of equity exposure that's considered acceptable for each. This does two things. One, it allows the portfolio to participate more in market rallies when the data feeding the algorithms is favorable to doing so. And two, it allows the portfolio to reduce equity market exposure when the data feeding the algorithm is unfavorable to doing so. So it's through this concept that market volatility is reduced. Our preferred investment strategy actually combines both tactical and traditional, or what is referred to as strategic or static investing. This allows the best of both worlds when they're combined in a way to allow for the right combination of upside potential and downside potential. Now, to be clear, our firm does not develop these portfolios or get involved in any way in the creation of the algorithms that trigger the trades within them. We use a company called Redwood who does that. They have the expertise to do this at a very high level, and they have done so for many years now. However, we do make the determination of which risk tolerance-based portfolio is right for each client. And we do this through a very thorough analysis and assessment of each client's portfolio and personal situation. So how do these portfolios work? Let's take a look at it. The main objective behind each portfolio is to find a comfort level that each of our clients have for the level of risk that each portfolio is exposed to. We do this by discussing the percentage of drawdown that each portfolio will be exposed to at any given time when it's invested. As you can see, the first and most conservative portfolio can expect anywhere from a 5% to a maximum of 8% drawdown or loss of assets at any given time. That does not mean that it can't at times draw down lower than this. It just means that this range is our goal at all times. So when we get together with clients, we take a look at how the portfolio did within these ranges. And if it stayed between them, then we know that the portfolio did its job. This does not mean that we do not talk, that we do not look at the performance of the portfolio as well. But since we know that if we can keep the volatility of the portfolio within these ranges, that over time, the portfolio should provide us, then over time, the portfolio should provide us with the long-term return goals that we have set with the clients. Let's take a look at what those returns can be when the portfolio stays within these drawdown ranges and goals. So as you can see, when this investment strategy was back tested based on the actual S&P 500 market conditions between the time of 2001, between the year 2001 and 2020, by controlling the volatility of each of these portfolios to keep between the allotted drawdown ranges, these redwood portfolios demonstrated more than adequate and competitive compounded returns. I must stress to you here that these are hypothetical because both redwood and these portfolios have not been in existence for that long. But based on all that we have discussed here today, I hope that you can see here and that you now understand the basis of how and why this is possible, especially when you think about what you've seen in terms of control and volatility. So folks, this concludes the workshop part of our webinar today. We sincerely hope that these portfolio insights that we've discussed with you today are as helpful to you as they are to us when reviewing your portfolio and in the future. Also, before we jump into our 6-question quiz, so I hope you're ready for that, and our Q&A for it, I want to make a special offer to everyone that is attending this webinar today. I usually charge $499 for a full portfolio review like the one we discussed here. But just for everyone here with us on this webinar today, I'm offering a complimentary portfolio review if you book it on my calendar before midnight tonight. However, if for some reason you can't book it tonight, I'll still offer everyone on the webinar a 50% discount if you book by Friday this week. Also, I want to take a minute to explain a little about what the review entails and what you can get and what you can possibly get out of it. So this is what it entails. First, there's 2 ways we can actually meet to do this. The first is online using Zoom, which is almost just like how we're doing this webinar tonight. But instead, we'll both be able to see each other and hear each other, and it will be completely private. Or secondly, we can meet in person in our office in Fort Washington, PA. It's just off the PA Turnpike, although I'm not sure if anybody would want to do that based on how the pandemic has been trending these days, but I'm open to it if we're going to wear masks. In order to schedule it, Rachel will be putting up a link in the comment box right now for you to book a 60-minute meeting on my calendar. If you do so before midnight tonight, the review will be completely free of charge for you. And secondly, it's a 2-step process. We would meet together to gather all the information that I'm going to need to do this review. And then we would meet a second time in order to go over the results of that review. Finally, what can you get out of this is a clear understanding of whether any of the portfolio factors and considerations that we discussed today can be applied to your portfolio in a way to help improve it. Okay, folks, we're now going to jump into our six question quiz and our Q&A questions before we wrap things up. And I hope that you all took some notes. Are you there, Rachel? You're still a panelist. Okay, hold on a second. All right, folks, hold on. I thought I made her a panelist already, but. All right, made you a panelist. Just made you a co-host. Hi, Rachel. I want to hear your voice.
Hi, I'm here. I've been here the whole time, but something happened with my computer earlier and I had to log out and log back in. It got all jammed up when I tried to turn my camera on.
Technical issues.
I'm here the whole time.
Okay. All right. So at least I wasn't talking to myself, right?
No, not at all.
Okay. All right. All right. First question. Oh, let me take this down. All right. First question. Name one asset class we discussed. Just one of the four. You're putting this in the chat box. Oh, Bob said fixed income. Angie said equity. You're quick to the trigger, yeah. Bob. Got to give out one to Bob, Angie.
Another one, cash. Somebody got cash.
Oh, John Cars. John said cash. All right, at least everybody was paying attention. All right. Got to give out one to Bob, though. All right. What is the first technique we discussed to reduce portfolio risk? The first technique we discussed to reduce portfolio risk. Bob. Hold on, Bob. Let's see if someone else can get it. But he already gave it away. Wow. Got to give it to Bob again. Bob's got 20 bucks in cards coming to him. Okay. Is an 80% equity and 20% fixed income portfolio considered aggressive or moderate? Try to give someone else a chance, Bob. Aggressive. Angie was right. You got that on your own anyway, Angie. You writing this down, Rachel? Are you? You writing it down?
Yes, I'm writing it down.
All right. Name one of the three types of investment management strategies we discussed. Remember I said it was a bullet point? One of the three types of investment management strategies we discussed. Passive, yes, that's correct. Oh, yes, that's correct. Is that Angie again?
Mm-hmm.
All right. Let's see. Name one. This is number 6. Name one of the 7 portfolio considerations that we discussed. It's a little harder because they weren't one-liners. But you can use it if you use a Nope. Risk reward. Yes, you're right, John. Looking at your portfolio's risk reward profile. Yes, that was number 5. So we got to give out one of the John cards. All right. We got them. That's all 6. So everybody who got one right and who was the first person is going to get a, so if you can do me a favor while we're at it, so Rachel can jot this down. Bob, you won the first 2. Where do you want the gift card from? Walmart. Bob likes Walmart. Bob won a card, I think, maybe 3 of our last 4 webinars. So, all right, then, Angie. So let me tell you this. How I usually, Bob, Walmart, I can send a physical card by mail. They'll send it directly to your home. The other ones that do, you still haven't used the last 2. You're getting them all together so you get a big purchase, right, Bob? But 2 of the ones that I can send you by email and you can have them instantly are Target and Amazon. But it doesn't matter to me. I mean, I haven't found any that don't sell them. So, Angie, where would you like your gift card to be?
Amazon, good choice.
Amazon, all right. And now, John, how about you? John, Amazon. All right. Yes, people after my own heart. I love Amazon. All right, so we got that down, Rach?
Yep, got it.
All right, now let's look and see if there's any questions here. You want to read them out, Rach?
Yeah, it doesn't look, let me see. We've got, what is a good rate of return for a portfolio today?
What's a good rate of return for a portfolio? That's a good question. And actually, we were just looking at the numbers, right? So we know the S&P 500 returned 7.45% over the last 20 years. So it's my belief that, man, if you could match the S&P 500, which most portfolio managers can't do, you'd be doing pretty darn good. But anything north of 7% prior to inflation, I think would be pretty good long term. Okay, here's one from John. If money's were in stocks, tax deferred, okay, so it's in like a 401k or an IRA, and yield has been very profitable, when should you consider cashing out? Well, that's a real good question. I think that you know, if you're in tax deferred, you got to be careful about how you're going to cash out. You're in an IRA, you're going to pay income tax. You can pay tax at the income level. So obviously, the more you cash out, the higher your taxes are going to be for that year. And that could actually cause a domino effect. That could actually cause you to have to pay higher Medicare surcharges and things like that as well. So it's always my feeling that cashing out should be done incrementally, and it should be done while paying attention to the different tax brackets that exist as opposed to what tax bracket you're in. Prior to you getting to that next tax bracket, I would probably space the amount that you take, especially from tax deferred, by doing that. I wouldn't recommend mainly tax deferred coming out in large lump sums at all. Unless it's an absolute emergency, that your life or death. All right.
If there's another one, what type of investments do you recommend for an IRA or for a Roth IRA?
Okay, so, well, I think this just really comes down to what type of investments do I prefer. And so I did break down recently and bought a couple grand of Bitcoin, but I am not an advocate of that by no means. And personally, I'm really not a major advocate of individual stocks as well. And right now, real estate is not really a buyer's market. So I'm really fond of exchange traded funds myself personally. Well managed, well designed exchange traded funds. And I think in either a Roth IRA or an IRA, because I feel like they diversify better than anybody can do on their own. In most cases, if you buy them from the right manager. So that's my shooting from the hip. The reason I don't like individual stocks is because it's not that I don't like them. I lean more towards the dividend producing stocks. And if you were looking to make income off of them, and that can be a good thing, problem is that you're going to deal with a lot of volatility. And usually, unless the portfolio has, hundreds and hundreds of stocks in it, and they're well chosen, if not thousands, it may not go up and down the same as the market, the S&P, the Dow, the NASDAQ. So you might see losses with the market, but not gains. And I don't advocate that. So usually with the exchange traded funds or mutual funds, I prefer exchange traded funds because you can get in and out of them quicker. If there is a major correction, like what happened last year, it happened fast. When a mutual fund, you have to wait till 4 o'clock to get out. There could be a lot of losses before that. So that's the long and short of it, mainly the long. All right, what else, Rach?
Here. What is the most common mistakes that you see when building a portfolio?
So what are the most common mistakes? I would say, well, the old, stereotypical buying high and selling low. A lot of people these days are infatuated with various different kinds of investments, equity investments. And they get excited when something like, say Tesla or what have you is really, going skyrocket, or when Apple was going through the roof, and they buy, when it's high. And then, Tesla had some lean years as well, and they sold when it was low. So I'd say that stereotypical thing. Anything else?
How many investments should be inside a portfolio for it to be well diversified?
But if you're Warren Buffett, it could be 15 or 20. But if you're the average person, in my opinion, this is the reason why I like exchange traded funds and mutual funds, I like to have the power of numbers. I would like to see thousands in there, well-chosen investments of the various asset allocations, so that your diversification is really just totally overwhelms the possibility of any individual investment or any individual sector of the market, causing a problem. But, if your average person, I think hundreds and hundreds, I would say, if you're choosing individual stocks, if you're choosing ETFs, you could have 4 or 5. And within each of them could be thousands and thousands. That's okay. You can do it like that as well.
Okay, there's one more. Which is better? A portfolio of individual stocks versus mutual funds or ETFs?
Well, I think I already answered that. I mean, it's not to say that if you're a good stock picker and if you're patient, you time things right, that you can't purchase those stocks at, when there's a correction or with that, with the market or what have you, and get a good price. It's not to say that, but again, I think like the average investor, especially somebody who's like contributing regularly to a 401k or an IRA, I personally like ETFs or mutual funds. If you're younger and if you have a long time horizon, like most, people investing into 401ks, and that's why most of the time it's mutual funds inside 401ks. You're not going to have to worry about timing getting out of an investment for a long, long time. So whether they close the market at 4 or you can get it on an ETF immediately, not going to matter so much to you. So mutual funds just as well. If you're older, retired, living off your portfolio, I prefer an ETF. Again, unless you're a really savvy stock picker and you have patience, and you can buy stocks, early on and get them for a great value, well then, that type of person, that's not me, believe me. That kind of person could go with a stock, but otherwise I'd say mutual funds and ETFs.
Okay, that was it.
All right, so now okay, so references. So Rachel's also putting up our references into our comment box. Anyone who's interested, they could please feel free to look through these for more information. We're going to leave the actual webinar software open for about a half hour after we finish, just so if anybody wants to go back into the comment box and copy and paste anything out into a Word document or an email, you'll have time to do it. So that concludes our workshop for today. I just want to thank everyone who's attending, for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic. I truly commend you for that. I want to remind you that if you have any questions related to this topic we covered today or our offer of the complimentary portfolio review, or if we did not answer your question in the comment box or anything else for that matter that you may have, a question you may have later, and you would like to discuss it with me further, Rachel's also going to be putting up a link for a complimentary 15-minute Q&A meeting, which is also done through a Zoom meeting that you can schedule. So you can schedule a time on my calendar at your convenience as well. So that's all for today, folks. On behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, Brian Dougherty of PLC Financial Solutions, located in the Fort Washington, PA area, Also, you can reach us at either 215-804-9708. You can put that up on there too, Rach, by phone, or at info@plcfs.com. Or to make it even easier, you can just go to our website at plcfs.com, and all our information is always there. Also, please mark Tuesday, January 25th, 2022. I can't believe I'm saying that. At 7 p.m. on your calendar for our next webinar. Remember, we do them at the last Tuesday of every month. Have a super happy New Year's Eve, and we'll see you then. Good night, folks.
Happy New Year, everybody. Thanks.